How fast can crypto borrowing happen depends less on blockchain speed and more on product design. The risk is fixed loans process each request, while credit lines create borrowing capacity before the moment of need. What can be stated clearly is fixed loans require issuance, while credit lines allow draws after collateral setup. The cleaner lens is always on access, not faster approvals. The anchor number is credit limit, while drawn funds shows the scale already visible. That keeps the opening question tight. Can crypto loans move past collateral terms without the story outrunning its evidence? A viewer who only sees faster approvals misses why fixed loans and credit lines define the risk range. The confirmed context is CLAP. Finance is presented as a regulated platform where collateral creates a limit that users can draw against. It matters because the headline alone does not show how much pressure is already built into the setup. The key baseline is credit limit, while drawn funds gives the story its scale. This prevents the segment from drifting into a generic market read. The baseline is specific, and the next test has to stay specific too. That baseline also explains why credit lines belongs in the setup rather than the conclusion. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The mechanism is a credit line separates setup from execution. Interest applies only to drawn funds, while unused capacity remains available. That is why faster approvals is not enough to judge the story. The test is whether the mechanism survives real pressure, especially around collateral terms. The mechanism also explains why the same headline can produce different outcomes. If the process behind it is weak, attention fades. If the process holds, behavior can change. The mechanism ties credit limit to fixed loans, so the next reaction is not random. The group with the closest exposure is credit lines. In volatile markets, immediate access can matter for hedging, liquidity needs, or time-sensitive opportunities. The consequence is practical. Decisions get made around access, liquidity, trust, or timing before the final answer is available. The story should not be inflated beyond that scope. The strongest reading stays tied to drawn funds and the observable path toward fixed loans. Collateral also matters here, because it shapes the route from always-on access to actual decisions. The confirmed facts do not settle everything. Speed does not remove collateral risk. Borrowers still need to understand margin, liquidation terms, and platform controls. This matters because treating the unresolved part as fact would overstate the story and mislead the viewer. The open side also tells viewers exactly what evidence is still missing. That evidence is not a mood shift. It is the concrete signal around collateral terms. The proof has to appear in collateral terms, not just in repeated claims about crypto loans. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. For how fast can, the next signal is whether more platforms move from event-based loan approval toward always-on credit frameworks. A clean confirmation would make the pressure point easier to read. A failure would show that always-on access is still the unresolved center of the story. The closing read is to track the trigger, not the loudest claim. Crypto loans only gets a stronger case if the next signal appears. That is why the final read stays tied to fixed loans, credit lines, and collateral terms.